Do you want to profit when the markets go down, but think shorting stocks is too risky? Well, I don't blame you. In that case, I've got just the trade for you today, and that's buying and selling put options the right way. In this video, I'm going to cover buying puts, selling a spread, and I'll even explain a way that you can use put options to buy a stock at the price that you want. Kind of like a name your own price, but for buying stocks. Now, there's going to be a lot of information in this video, and as usual, if you have any questions, let me know in the comments below because I'll be more than happy to answer them for you. But before we jump in, I publish a lot about stocks and options trading, strategy videos, and so on. So make sure you hit that subscribe button and press the notification bell so that you don't miss out on any of my new stuff moving forward. And remember, these strategies work in any market condition. So it's practically everything that I've learned in my 20 years of trading stocks and options. Okay, so let's get right into it, and we're going to talk about how you can make money using put options. The most common definition for put options that you'll find on Google is this. Put options is a contract that grants the buyer the right, but not the obligation, to sell an underlying security or an asset at a specified price within a specified time frame. And that means that traders that buy put options, well, they can profit from a decrease in the underlying stock price. Not only that, the potential profits are bigger compared to just shorting stocks alone, since options are highly leveraged, so they give you much more exposure to the market. Now, if you want to see how much bigger options profits can be, let's look at a recent stock that experienced a sudden price drop. TransUnion, or TRU, went down $15.11, or 23%, on October 24th due to its missing its earning expectations. And this is how the stock price looks today. Now, any trader who entered a short position right before the drop, let's say with 20 shares at $65 or a $1,300 total investment, now has made about $269 in profit based on the last trading price of $51.54. But if the same trader bought 5 put options instead, with a $65 strike for a $2.50 premium or a $1,250 total investment, well, now that trader would have over $5,400 in profit, and that's a huge difference. Now, before you jump into your favorite options trading platform and hit that sell to open button, let me explain how it's possible to extract these massive profits from the markets using options. And we'll start with buying puts, or we're going to say going long puts. Long puts, or buying put options, is an options trading strategy that makes money or profits from a significant decrease in the underlying assets price. This is how we earn more than $5,000 with a $1,250 investment in the TRU example. With that trade, the buyer pays for the right to sell an asset at a specified price within a specified time. And the payment is called the premium, and the specified price is called the strike price. And the end of the time frame, well, that's called the expiration. The great thing about long puts and buying options in general is that you take on a leveraged position, meaning you have more exposure to profitable price movements than you otherwise would have if you just bought the stock outright. Now, another good thing about long puts is that it limits your risks. Your risks are defined. Now, when I'm looking for opportunities to buy long puts, I don't have to go, or I don't want to have to go through the entire NASDAQ or New York Stock Exchange and sift through options chains just to find the perfect underlying stock. I mean, who really has time to do that? Instead, I use an options scanner like Option Samurai, and it helps me search for opportunities. I can choose my preferred strategy, and the scanner, I mean, it's kind of like a search engine. Well, it gives me the best potential stocks depending on the criteria that I set. And this cuts my research time from hours a day to literally no time at all. All right, so let's open up optionsamurai.com. And if you don't already have an account, sign up is easy and you get a 14-day free trial. No credit card is needed, and you even get a discount. There's a link in the description below if you want to know more about it. Now, once you have the account, all you need to do is click on Compose Scan, and this is where, and then click on where it says Covered Call. That's where you can choose your option strategy. And in this case, let's start with choosing the long put. And as you can see, the scanner automatically starts showing results. It's really that simple. But wait, the whole point of an option scanner is to give you the best chances of profitability. So let's go down to the filter section of the search and then click Add Filter. And on the search bar at the top, type in delta and then click on it to add the filters. Now, delta is the degree to which an options price moves in relation to a $1 change of an underlying asset. So for put options, delta is explained on a scale between -1 and 0. Now, here's a little secret. I use delta as a way to measure the chances of the option being profitable at expiration. So for me, if a put option has a -70 delta, that means it has a 70% chance of expiring in the money. It's like a shortcut. So back to Option Samurai. Let's click on delta, and we'll use the sliders to define our range from -1 or -100 to -70. So the scanner gives us options with -70 and below of delta. And remember, every time you change something in the filters, you need to click on Run Scan to get the new results. And there we go. We now have a bunch of new options that have a -70 delta or below, or a more than 70% chance of expiring profitable. And if you think that 70% chance of making money with options is good, well, give me a like on this video. Okay, so here's the list. Let's choose Amazon. And as you can see, it has a delta of -77.19, or a 77.19% chance of being profitable. So here we can see the strike prices, expiration dates, and premium price ranges. So let's take what the scanner suggested, which is to buy a put option on Amazon, and it's trading for $142.71. And for between $2.45 to $2.70 per share, with a $145 strike price that expires on November 10th. Let's go through those details on a graph. All right, so we're going to start with a break-even price. To calculate, we're going to use this formula. So the strike price minus the premium paid. For simplicity, let's say that you paid $2.50 per share for the contract. That makes our break-even price $142.50. That means you'll profit if the stock moves below $142.50. Now, for a profit scenario, again, long put options are more profitable the more the underlying stock drops below the break-even price. Now, let's assume Amazon's price went down to $135, which is about a 5.4% decrease at or before expiration, and you choose to exercise your option. Well, to calculate the profit, you'll take the break-even price and subtract the underlying stock price at expiration, or the exercise date. If that's a positive number, then you are making money. Now, if it's a negative number, then there's no point to exercise. Now, in this case, you'd have made $750 per contract. And on this trade, if you had 5 long puts, you'd make $3,750 in profits from just $1,250 in total capital to buy those puts. Maximum losses for long puts happen when the stock price goes above the strike price. However, the good thing about long puts is that the losses are limited to the premium paid at the start of the trade. So no matter how much the stock price goes above $145, your losses, they're capped at the $2.50 per share or $250 per contract. So long puts allow you to profit in any downward price movement while limiting your losses. And they're great ways to make money during down markets when the markets are moving down. Another put option strategy that I love using to make money on is to sell bull put spreads. Bull put spreads involves buying and selling put options with the same expiration dates, but with different strike prices. Now, I love spreads because the trade usually requires very little money to get started, and you can sell hundreds of them if you want. Now, directionally, even though we're using put options, this is a bullish strategy. So this is a way that you can buy and sell put options when markets are moving up, hence the word bull. Now, if markets are moving down and you want to sell a spread, well, you're going to want to sell what's called a bear call spread. And you can learn more about them up here in this video. Now, when you sell a bull put spread, also known as a put credit spread, you make money when the short option expires worthless. That way you get to keep the premium. Now, the nice thing about bull put spreads is that oftentimes the risk is very low, like $50, $100, $200. And since that's the case, the profits are also low. But remember that bull puts with bull put spreads, you get the premium right away in your brokerage account. Now, considering that spreads have two legs, that means two options are used for the trade. And here's a little chart to remember the strategy's two trade legs. Again, we can use an option scanner to find opportunities. And for this trade, we start by changing the long put to a bull put spread. And this time, we'll use the probability of max profit filter. So we check the filter if it's already populated, and it looks like it was, and we're just going to change this to, I don't know, let's say 70%. And here's the results. On this list, to me, NVIDIA looks the most promising with an 81.46% chance of profit. Now think about that. An 81% chance that you're going to make money on this trade. These odds, I mean, they're very good. So Option Samurai tells us that we can write a put with a $442.50 strike price for around $6, and then buy a put with a $437.50 strike price for around $5.05, expiring on November 24th. So let's see how this trade plays out. The maximum profit of a bull put spread is the difference between the premium earned from the short put and the premium paid for the long put. And you get that when you initiate the trade right away. And as long as both legs expire worthless or NVIDIA's price stays above $442.50 until expiration, well, you'll get to keep the whole thing. Now let's take the max values from the range, and we get 95 cents a share or $95 per contract. And remember, you don't have to limit yourself to just one option. You can do this 5, 10, 20 times with either the same or different strike prices. If you sold 10 of these, you'd earn $950. Now, a bull put spread's break-even price is calculated by taking the short put strike price and subtracting the premium received. And that makes our break-even price $441.50. Now, you might be tempted to adjust your trade if the stock approaches the key point, but With spreads, I find that it's usually better to let them expire worthless if the trade is going in the wrong way. Fiddling with them can cause you to overtrade and pay more in commissions and just lose much more money. So I like to think of spreads as a set it and forget it trade. It's not to say don't adjust, it's just be conservative with the adjustments. Now, bull put spreads, they have limited losses, and that happens when the stock price goes to or below the short put's strike price at expiration. And this is calculated by taking the width of the spread, or the difference between the strike prices, and subtracting the net profit. And in this case, the maximum risk is $405 per contract. So again, bull put spreads, they have limited profits and limited losses, but they don't require a lot of capital to start, and you get the profit upfront through premiums. And this put option strategy is excellent for making money from moderate increases in stock prices. And last but not least, we have cash secured puts. Now, selling put options is a bit trickier than just buying puts alone. People who sell put options do so to collect the premium, and they make money when the option expires worthless. Now, writing or selling put options also means that you must buy the stock at the strike price should the buyer exercise their right. So it's natural that you'll need enough money or margin in your account to actually buy the underlying stock if you were assigned. And this is where the name cash secured puts comes from. Oh, and you may have heard of naked puts, and that's exactly the same thing as a cash secured put. It's just a different way of saying it. Now, if you're looking to sell puts, the first thing you need to know is your chances of profitability. And for that, I'm going to go back to Option Samurai. Since we want the option to expire out of the money, let's go ahead and tweak the probability of expiring worthless filter, and let's set it up to 80% probability, and then we'll hit the run scan. And there we have it, a bunch of trades that have an 80% chance and above of expiring worthless. Now, when selling puts, your maximum profit is the premium received, and you get to keep that no matter what happens. Now, the maximum loss condition, well, that'll happen if the stock drops to zero, which is unlikely, but it's still possible. And that's why I like to adjust the probability of expiring worthless in my scans to give me the best chances of pocketing the entire premium. Now, there's one thing that's really cool about selling cash secured puts, and it's the fact that you can do so to kind of name your own price on buying a stock, as I was talking about at the beginning of the video. Let's say, for example, you want to buy Tesla, and you just see that the price keeps going up and up and up, but you want to get it at a lower price. Now, Tesla last traded for $223, and let's say you want to pay $210 for it, for example. You could sell a put option with a $210 strike price, and let's say with an expiration 3 months from now. As you can see in this options chain, this option is bid at $10.90 a share, or $1,090 per contract. So here's what you could do. If you were happy to buy 100 shares of Tesla at $210 each, you could sell this put option today, collect $1,090, and if the stock dropped below $210, you'll be assigned, and you'll buy 100 shares at $210 a piece. You're going to save $13.71 off today's price, and don't forget you also got $10.90 in premium. Now, if Tesla stock stays above $210 between now and expiration, you still get to keep your premium, that $1,090 that you received. It's income you get to keep. and then you could just sell another put option at a different expiration date and strike price if you wish. So that's it for this video about making money with put options. I hope it was valuable to you. Now, the whole point of the channel is to teach you about how to earn money using stocks and options while protecting yourself from significant losses. As such, I highly recommend using platforms like Option Samurai and Barchart because these give you the best chances of being profitable. And remember, investing doesn't have to be, and it shouldn't be, gambling. If you enjoyed learning about these particular strategies, don't be shy. Feel free to like on the video and share it with your friends. And while you're down there, if you haven't already done so, feel free to subscribe and click on that notification bell so that you get updated on all of the new videos. In the meantime, thank you so much for watching, and I'll see you in the next video.